Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. I want to thank everybody for joining us this Saturday. Hope everybody is having a great weekend, a great week, a great year. My name is Robert Kuhn. I am the host of Destination Retirement. I also am the president and founder of Kuhn Capital Partners, independent registered investment advisory firm. Everything that we do is to create and include strategies that can do well regardless of what the markets are doing. As you know, markets can go up, they can go down, and they can go sideways. Everybody has strategies in place that'll do well in an up market. Very few have strategies that can actually make money in a down market or a sideways market. And in addition to financial planning and growth and alternative and tax strategies, that is what we are doing for our clients, especially in this market. I think it's very critical, very important to make sure before the markets either run up or fall off a cliff that you know that you can weather the storm in a down market and even make significant gains in an up market. We do have this show run in multiple markets. So if you're hearing my voice, then we can work with you. We are headquartered out of Naperville. We did just recently move our office to Naperville. We are at the 88 and 59. So we are very happy with that in the Calamos building, Calamos Investment Building. If you know that, we are on the second floor, Suite 200. So for those that did not want to move or drive out to Geneva, we are much more centrally located. So with that being said, give Paige a call. Any investment questions you have, any 401k questions you have, financial planning questions you have. If you own an annuity that has not grown, let's talk about our annuity repair strategy. I can't tell you how many shows on the radio. That is what they push. And you may not know it, but as soon as you call them, you will know it. Not to say that is bad, but look at the growth. And that is and has been a significant problem. So 630-492-1912, 630-492-1912. Paige will set some time up for us to have a conversation. And generally, we like to have an initial consult as far as what you're hoping to accomplish, what your expectations are. Allow us to share with you a little bit of what we do, why we are unique, why we are different, why we do add strategies that can do well when the markets don't do well. And we'll go over some of those today. So again, 630-492-1912 and set that initial consultation up. A couple things. Busy start to the year, obviously, with the market. It's I can't tell you how many people we've talked with that have missed this run in the market because the markets have to go down is what they have been told or what they have thought. So many people have sat in cash, and while cash is paying 5%, 5.25%, certainly better than what it has been historically, that does not mean that it's keeping up with inflation. And again, when you're using a buy and hold strategy that is not based on mathematics, based on trend following, based on what the computers are telling you, because 90 to 95% of the trading volume on the exchanges today, in our opinion, and the reports back it, is computer driven. You're just missing out, and you're just buying and hoping, and that is not a strategy. So a couple things that I want to go over today. We're going to go over taxes. We're going to go over tax strategies, how to reduce your taxable income. We're going to go over what does it mean to create a fearless retirement. I think at the end of the day, that is what we want all of our clients to experience, is a fearless retirement. And what does that mean? And how can you create a fearless retirement, at least when it comes to investing, because that's the only thing that we can control. Then we're going to go over our dual directional and our protection strategy. So a lot to get to. Thank you for joining us. And we will be the shows. The first month of January is very busy. So we've had best of shows. We're now back. And until the middle of summer, we will be the shows will be current, and we are really excited about that. So we did have a dinner in Naperville at Morton's. We had 2 dinners so far this month, and those dinners have been great. If you want to get on that dinner list, we are having future dinners in generally we follow Morton's, so wherever they are at. So downtown Chicago, certainly in Naperville, Schaumburg, Northbrook, and so those are our schedules. So the dinners are for those investors. Again, we work with investors regardless of the asset base you have. So you could have $100,000, you could have $10 million. Certainly the strategies will change, but we are here to help you regardless of your investable assets. But the dinners are specifically geared for those individuals that have over $1 million of investable assets, because they are qualified. And unfortunately, it's not my qualification. It's the SEC's qualification to invest in the strategies that we talk about at the dinner. And so tax strategies that can reduce your taxable income 60, 70, 80% and still pay significant distributions targeted in the 13 to 18% range. So if you sold a building, if you're a high wage earner, if you sold a business, if you have concentrated stock that you're trying to not get out of because you're worried about the taxes, those are the conversations that we want to have at those dinners. And we have some guests that fly in and go over the energy strategies and why it is so unique for the retail investor. I can't tell you how unique it is. But again, if you want to reduce your taxable income by 70 to 80%, offset active passive income, reduce capital gains, make sure you reach out to us, 630-492-1912. And again, if you're near a Morton's restaurant, we will certainly be in the area at some point, and we will put you on that list. So I know the steak is good, and a lot of people come for the steak, but I guarantee you will leave with knowledge that you did not have before the dinner. So distributions, irregardless of what is going on in the market, and significant tax reduction strategy. So as you know, if you've listened to the show at any point in time, that the most overlooked area of financial planning, in our opinion, is proactive tax strategies. I saw the other day they were having a dinner in St. Charles, another firm, and it was taxes in retirement. And I looked at the topics that they were going to go over, and I would really argue that those aren't really tax strategies, because if the most proactive you get with your advisor is trying to match gains with losses or do Roth conversions, that is not in any way, shape, or form proactive tax management. Unfortunately, if you're with a big bank or if you're with a big brokerage firm, that is generally to the extent that is the extent of tax planning, tax strategies you're going to get, and it's just not good enough. When you look at the tax code, and if you look at the energy space, the tax benefits are significant. Everybody says real estate, real estate, real estate. I think they say real estate as far as taxes. Yes, passive income is great, but real estate is something that everybody can ultimately get into, right? The challenge with that is it's not going to greatly reduce your taxable income. I mean, we're talking about strategies that if you invest $100,000, you can reduce your taxable income on average by $75,000 to $80,000. If you invest $1 million, you can reduce your taxable income by $75,000 to $750,000 to $800,000. And again, I can't provide tax advice because I'm not a licensed tax professional. So these tax strategies strategies are relatively basic, but we always do suggest you talk with a tax professional that you use just to confirm. Obviously, it's important to do, but they're very basic tax strategies. And when you can get that type of tax treatment, that type of tax benefit, along with distributions that are targeted to be in the 13 to 18% range that are independent of the stock and bond market, that is just obviously something that is very, very unique to us. And it's certainly something that we want to have a conversation with. So 630-492-1912, 630-492-1912. The markets, again, a lot of great statistics we're going to get to today that I think are going to ultimately make you think. Everybody thinks that the markets have to go down. They have to crash. The markets don't have to do anything. There is risk. There is significant risk, I think, to the downside, but that doesn't mean that the downside is going to happen. I think if your portfolio is positioned correctly, then you can take advantage of that market volatility. And I really want you to sit here and think something just for a second. Most advisors all sound the same. They all talk about the same things. They all sound very educated. They all talk about strategies on how we're going to reduce portfolio losses, but most advisors are crafting our closet index fund strategies. What I mean by that is strategies that are simply going to track the market up and track the market down. And you're going to pay an advisor for the right to do nothing more than what the markets do. Newsflash, you can do that on your own. You don't need to pay an advisor to do that. The problem with that strategy is, first off, I don't think that's how you acquire wealth. I don't think it's simply, time in the market. You have to have strategies inside of your portfolio that can do well regardless of what is going on in the market. And that is when you know you have an advisor that is bringing value to the table. That is something that we focus on. And it is unique because when we look at an investor, very first and foremost, we want to obviously have strategies that you're familiar with, but we also want to have strategies that you probably are not familiar with. Again, if we just bring investing back to its simplest form, the markets can go up, they can go down, and they can go sideways. That is it. And we know sideways markets and down markets are the greatest destroyer of compound returns. They're the greatest destroyer of wealth. And for those investors that think that the markets can't stay down for an extended period of time, we don't have to go back to the dark ages. We just have to go back to 2000 when the markets, if you had bought Microsoft in 2000, it took you 14 years to get back to even. You can do the math, you can do the chart just like I did, and you have to look at that. And I talk a lot about that today because of where the market is. And, that is a concern of mine because, generally speaking, we work with individuals in their 50s, 60s, 70s, and 80s. And we have a lot of clients that are 5 to 10 years from retirement. We have a lot of clients that have just recently retired within the last 5 to 10 years. And losses in the market at the wrong time can just create stress that's not needed. The problem is when you meet with an advisor, they're going to show you what the portfolio did yesterday, what it did the last year, 2 years, 5 years, 7 years, 10 years. That is irrelevant to what is going to happen tomorrow or over the next 3 to 5 to 7 to 10 years. Think about it. Do you think an advisor is going to show you a bad portfolio over the last 3 to 5 to 7 years? No, because you wouldn't hire them. And I am very, very convinced that certainly the way Wall Street invests their firm's money, but more, let's bring it, even nearer to home. Those advisors that you're working with, I would almost guarantee you they are investing their money differently than the advice that they are giving. Most advisors are not going to just buy and hold. Never. Most advisors managing their own money, their family money, they're not going to just buy and hold. Yet that is the strategy that they're ultimately going to provide to the client. Why is that? Because it's easy to implement. It's easy to manage. It's easy to scale. And if you're collecting a 1 to 1.5% management fee on a few $100 million, that's a good living, right? But yet that doesn't mean that that is how they are managing their personal assets or their family assets. And we're on a mission to change that. We're on a mission to make sure that individual investors, whether you have $100,000 of investable assets or you have $10 to $15 to $20 million of investable assets, that you are receiving the same strategies, the same benefits that advisors are with their own money and Wall Street is with the firm money. Because again, when the markets can go up, down, and sideways, we want to have strategies that are protected, strategies that can grow, opportunistic growth, and then strategies that can create tax benefits. So with that being said, a lot to get to this week. We're going to go over some fascinating statistics after the break. If you want to have an initial conversation, please give Paige a call, 630-492-1912, 630-492-1912.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our clients' financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, host of this radio show, also president and founder of Kuhn Capital Partners. We're a registered investment advisory firm, and yes, we are a fiduciary. Everything that we do is to create and craft portfolios that can do well, whether the markets are up, down, and sideways. I think it's all about creating a fearless retirement, and fearless retirement, what we can control, is all about your investments. Again, you have to look at a portfolio and see, can you point to strategies that'll do well when the markets are down? Do you have a strategy that is a predefined outcome where if the markets are down 20%, that you could make 20%? Unfortunately, most advisors do not use those strategies because it takes some education to clients, and it's always easier just to create a closet index fund strategy and collect a 1% to 2% fee on a few $100 million, and their lives are good. Well, that's not how we manage money. So we want to create strategies, create portfolios, have strategies that we use inside portfolios that can do well and do exactly what I mentioned earlier. If the markets are down, yes, you can actually make money. We love volatility. We love market chaos because a lot of money can be made if you have the correct strategies in place to offset that equity risk. The challenge is most investors are simply riding the market up and down, and that's not good enough. So with that being said, if you want to talk about strategies that can greatly reduce your taxable income, strategies that can do well when the markets don't do well, strategies that can actually make money when the markets are down, that are offered by the largest financial institutions and banks in the world, give Paige a call. Let's have our initial conversation. 630-492-1912. 630-492-1912. So back to our dinners. Yes, we are doing dinners again. The dinners are targeted for individuals who have over $1 million of investable assets. Those investors who want to reduce taxable income to the tune of $70,000 to $80,000 per $100,000 invested. We have chosen to do the dinners at Morton's. Yes, the steak is great. Yes, the steak is free, but I promise you're going to walk away with more knowledge than you came in. And so we just started doing those in Naperville. We have them scheduled out in Schaumburg, in Northbrook, in downtown. So if you do meet that criteria of $1 million of investable assets or more, if you want to learn about strategies that can provide distributions in the 12 to 13 to 18% range that are not dependent upon the market, that can greatly reduce your taxable income, give Paige a call. She will get you on the calendar for those dinners, 630-492-1912. It's good to have a conversation before the dinner so we don't waste your time. And candidly, we save more space for people who are interested in the strategies, so we can have that 5 to 10 minute call on what the dinners are about. 630-492-1912. That said, if you're hearing my voice, we can work with you. We are headquartered in Naperville, but we do have offices and we do run the show in multiple markets. So if you're out of the Naperville area, we can certainly work with you if you are hearing this show. So we'd love to have a conversation with you. Okay, equity markets in 2024. Equity markets in 2024. What has to happen? Well, nothing has to happen. The markets can continue to go up 20, 30, 40, 50%. And people who are working with advisors that don't have mathematical models, trend following models that are in place inside of their portfolio, then you may miss a lot of the significant upside. It can also go down 20 to 30 to 40%. And those investors that don't have protection strategies in place that can actually make money when the markets are down, or strategies in place that can pay distributions, it doesn't matter what happens in the markets, well, then you're going to lose money. But what if you had both? What if you had both strategies in place? Then you really wouldn't be so worried about what is going on in the market, because you're protected. You're protected in an up market. You're protected in a down market. That's why when we talk about the markets, we don't know. We could care less which directions the markets go. Yes, it's a lot easier if the markets go vertical. I mean, our income goes up, our portfolios go up. I mean, it's great, but that it doesn't mean that the markets have to go up. And that's the problem with this industry. The industry is every advisor you're going to meet with, they're going to either tell you that the markets are going to go down forever, and they're going to scare you into an annuity or into a strategy that doesn't grow. Or you have the advisor that is going to simply tell you the markets are always going to go up. It's time in the market, not timing the market. You're not smart enough to beat the market. And all of those things may be true, but then if you just have a buy and hold strategy, why are you working with an advisor? Why are you paying the advisor the fee? What value are they bringing to the table? So I want you to think, if you're driving around or if you're catching this on a podcast, think about your portfolio. I want to know if you can point to a strategy that you know for a fact you would make money if the markets were down. If you can't, then we have to have a conversation, because the strategies that we're using today in our protection bucket, again, investing is nothing more than having different strategies that have different return drivers. The problem is most people only have two things. They have equities and they have bonds. Now, you may be over-diversified in each of those asset classes, but you still only own two things. So go back to 2022. So I want you to just sit and think, would you consider an investment for some of your money that had the following characteristics tied to the S&P? So let's say it's a short-term investment, 15 months, all right? Very basic. They look at the S&P 500 today. Then in 15 months, they're going to look at the S&P 500 again. You get the first 20% of the upside of the S&P. So the markets are up 5, you get 5. They're up 10, you get 10. They're up 15, you get 15. Anywhere from 0 to 20, those are the returns that you get, 100% of those returns. You get nothing over 20%. Now, again, this isn't all of our money. This is our protection money, okay? Protection. This is what you have to think about. So 0 to 20 is what you get. On the downside, let's say we had a 20% downside buffer. What that means is you make the inverse return from 0 to negative 20. Simple math. Markets are down 5, you're positive 5. They're down 10, you're positive 10. 15, you're positive 15. 20, you're positive 20. So if the markets are down anywhere from 0 to negative 20, your returns are the positive. The banks offer these strategies. This is not some too good to be true strategy. We've been using these strategies for 15 to 20 years. Here's what's happened. You used to have a significant net worth or a significant access or initial investment. Here's the minimums today. $1,000. Okay, $1,000. So you had a cap on the upside. Now they've changed. All right, I'm just giving you ranges. It may only be 18%. It may be 25%. But just so you get the basic understanding, you have some cap on the upside over a 15-month period. And then you have some protection on the downside. We usually like to use 15% protection or 20% protection. So what happens if the markets are down more than that? That's when you start to lose money. So if the markets are down 20%, let's say you had a 20% buffer, right? So you don't experience the first 20% downside of the market. And in this instance, in this example, it was the S&P 500. So if the S&P 500 after 15 months was down 21%, you were only down 1. 22, you were down 2. So look at the first 20% downside that you don't experience. Every person who can hear this show should have 10, 15, 20% of their money in a strategy like that. Great cap on the upside, great protection on the downside and a big buffer that if, there's some sort of a catastrophic event in the market. So the equity markets in 2024, I don't know. I think we're seeing an uptick in retail fund flows. I think you have a lot of cash on the sidelines. The Fed rate hikes are supposed to be, well, they said 6. Now they're pricing in 4. Who knows what's going to ultimately happen with the markets? I mean, I think the markets are priced to perfection. I think that a lot has to happen to see significant upside from this point. The problem is advisors are always looking in the rearview mirror. It's just hard. When you manage 300, 500 clients, 1,000 clients, whatever it is, whether it's $100 million or $1 billion, it's hard to make changes inside of a portfolio, which is why advisors don't do it. They're just happy collecting their 1% fee, 1.5% fee, 2% fee, whatever that fee is. And then they're going to let the markets manage the risk. And that's just not good enough. So here's a couple things that I think could help the market this year. So retail fund flows are up. That is good. That's individuals. Retail is individuals. Institutions are, pension endowment, Wall Street, bigger pools of money. Historically, after a bear market hits a low point, as the U.S. stock market did in October of 2022, and that's what I was going to mention. Back to, this is kind of, if you listen to me, I go down these little rabbit holes and sometimes I forget things, right? But think of your portfolio in 2022. Equities were down, bonds were down. If that happened to you, you have to give us a call, 630-492-1912, because your portfolio is not good enough. It's not protecting you, and it's not going to grow as it could or should. 630-492-1912 if you lost money when the markets were down in your equities and bonds in 2022. Okay, so back to some things I think that are positive for 2024. Again, retail flows are up. So we hit a low in October 2022. It takes about a year of selling before retail investors realize that they actually should be buying at the right time. And that's the problem. The problem is the markets are driven by computers. You and your advisor, if you have a buy and hold strategy, you are fighting the computers. You are fighting firms that have 10, 50, 100 programmers on staff that are creating models that capture microsecond moves in the market. It is a very tough game to play. Again, that's why buy and hold generally is not going to outperform the big hedge funds. And here's the beauty. A lot of these hedge fund strategies that you just did not have access to, that you didn't meet the requirements, or candidly, that they just don't need retail money. Many of these strategies, many of these types of computer-based models are coming down to the individual investor level. But again, there's a pro and con to everything. And sometimes the volatility is a little bit greater, but just look at what's going on in the market. I mean, you look at semiconductors, they're up 10, they're down 10, they're up 10, they're down 10. What if you had a strategy in place that could actually take advantage of that volatility? Now, again, it doesn't mean you're getting in at the top and getting out at the bottom. That's a fool's game. I mean, it's very, very challenging to do. But individual investors are always buying and selling at the wrong time because the advisors, they don't have a mathematical plan or process in place. They don't have 4 distinctly different strategies like we do: our protection, our growth, our opportunistic growth, and then strategies that can greatly reduce your taxable income, and strategies that can pay you a 10 to 15 to 20% targeted distribution that's independent of the stock and bond market. So yes, there's a lot of cash. And yes, if the Fed cuts rates, if they can cut rates, you're going to see a lot of that money, in my opinion, flow into the equity markets. And that is something that you want to be there to participate in. I can't tell you how many people I've talked with that have underperformed the market 3, 5, 7% when the markets were up 20, 22% last year. And again, many people are paying for that. And that's just so unfortunate. But we're here to fix that. And that's why we're very passionate about making sure that we have clients that can make maximum amounts of money in the up market and strategies that can protect and still make money when the markets are down. I think that is the best of both worlds. And you can have it. You can have it if you're open to new strategies. This isn't cutting edge stuff. This is just strategies that you're not going to see on a 30-second commercial to make you feel good between, your favorite, TV show or a sports game on the weekend. So we're going to talk about the 4 other points that I believe we're going to help the markets in 2024 when I get back. But again, give Paige a call, 630-492-1912, 630-492-1912.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement and take advantage of the 2024 tax rules. Visit KuhnCP.com or call our office at 630-492-1912 to get started today.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent fiduciary registered investment advisory firm focusing on strategies that can do well, whether the markets are up, down, or sideways. If you do not have a strategy in your portfolio that you know for a fact that you can make money when the markets are down, then we need to talk. 630-492-1912, 630-492-1912. Tax strategies. We are hosting tax dinners, tax strategy dinners at Morton's throughout Chicago this year. If you have $1 million or more of investable assets and you want to learn about strategies that can reduce your taxable income by $75,000 to $80,000 per $100,000 invested with targeted distributions of 12 to 18% that are in the energy space, then you are going to want to attend these dinners. Give us a call. We'll have a quick conversation about what it is and what it's not to make sure that you're not wasting an hour and a half of your time. Yes, the food is good, no doubt about that. But more importantly, we want to really just educate you on how to reduce your taxable income and have a bucket of your money that is going to pay, targeted distributions of 12 to 18% that's not dependent on the stock and bond market. So give Paige a call. Tell her you want to learn more about the dinner, 630-492-1912. She'll set a conversation up with us, with me, so we can go over at 5-minute call on what it is, what it's not. If you still have an interest, we'll certainly set an RSVP for you. So we are doing that throughout the year. We are following Morton's throughout Chicago. So if Morton's is not too far for you, then give us a call, 630-492-1912. You can, again, that's $1 million or more. But if you've listened to the show, you know that we work with people regardless of your investable assets, 100,000, 10 million. It truly is irrelevant to us. We want to still provide intellectual capital that you're not going to see elsewhere. We're not cookie cutter. We're not going to have a closet index fund. We're not going to have strategies that simply track the market up and down, and then you pay us a fee for that. We are going to craft a portfolio that we have our protection bucket where we know that we can make money when the markets are down. At least we know to the parameters of what we can make if the markets are down. We're going to have our growth bucket. We're going to have our growth plus bucket where we're really trying to take advantage of mathematical models, utilize strategies that have 10, 20, 30, 50 programmers on staff, and they are crafting portfolios that are simply based on mathematics that can really, really run when the markets are doing well. And then they have some stops in place that we call them walk behind stops. And if you don't know what that is, so many people, the hardest thing to do is to let a stock or an investment run when you're making significant money, because you have to really, it's emotions, right? Oh my gosh, I'm up 100%. I'll take it. Well, what if it goes up 200%? What if it goes up 300%? Well, what if you had strategies in place that you put just a basic walking stock in place where it just followed the stock up, but you knew that you were going to get stopped out if it ultimately dropped a bit, so you're not giving up those gains. Those are the things that we're talking about. Those are the things that we can show you that the institutions are doing, that advisors are doing with their own money, their own family money, and those are the things that we want to have conversations about. 630-492-1912, 630-492-1912. 13, 12. And again, then strategies is our fourth bucket, is our tax advantage strategies. If you're working with a big bank, a big brokerage firm, you don't have access to cutting edge strategies at all when it comes to tax strategies. They just don't offer them to their clients. So, and again, it doesn't matter if you have 50 million, you're just not getting access to those strategies. So give us a call and we'll have some conversations about that. Okay. Equity markets in 2024. Again, nobody knows. Nobody knows what's going to happen. And candidly, I don't care what happens. It's easier for me to raise money as a firm if I'm looking at my agenda, not the client's agenda. But if I'm putting my agenda before yours, I would love the market to drop, because when you have clients, when you have strategies that have 40 to 50% of a portfolio that can do well when the markets are up, but still do well when the markets are down, that's very easy to raise money in, because most people who are listening to the show today, you do nothing more than track the market up and then track the market down. And when the markets drop 15 to 20%, your advisor tells you sit and wait. There was nothing you could do with, to prevent that. Ask them if that's what they do with their own money. I promise you it shouldn't be, and it's probably not. And if it is, then you definitely, have to question who you're working with. But again, so it's easier for us to raise money when the markets are down. But there's a lot of reasons the market can go down, and there's a lot of reasons the markets can go up. One of the reasons that Wall Street doesn't care and they make money no matter what happens is because of the computers. They have strategies that they can make money when the markets are down, make money when the markets are up. The problem is you didn't have access to them, and you don't have access to the bulk of them, but there are a handful of ones that are available to individuals. And those are the things that we want to bring you. Those are the things that allow our clients, I know it sounds corny, but to retire fearlessly. And if you want to retire fearlessly, where you don't have to worry about the market, you don't have to worry about the portfolio, you know that nothing is perfect. But if the markets drop and you've got a bucket of money that is making money, you're not worried about that in any way. When the markets run, who's to tell you that the markets can't go up another 10, 15, 20, 30, 40, 50, 60, 70%? And that's the difference between us and others, is I have no idea what the market's going to do. But I know I want to have strategies for maximum gain, and I want to have strategies for maximum protection. So retail fund flows are up. Generally speaking, when an incumbent president is on the ballot, now, again, we don't want to go down politics, right? But generally speaking, when an incumbent is on the presidential ballot, every time since 1994 that U.S. president was running for re-election, stocks posted a gain for that year. It hasn't mattered whether the incumbent won or not, but if they're on the ballot, they have posted an average gain of 16%. That's 13 different times that this happened. Now, again, does that mean that it's going to happen this time? Absolutely not. And that's the problem with individual investors. They think because every single time it's happened, it's got to happen again. Well, no, it just doesn't. And, the old adage of sell in May, go away. Well, sometimes it works, sometimes it doesn't. So just because something has happened doesn't mean it's going to happen. And people and advisors are making decisions simply based on that. And my contention is this: you have to have a portfolio that it doesn't matter what happens in the market, that you can protect and you can grow. And that is our job. But again, it is a reason why that I do believe that, I'm not necessarily so worried about the market this year. So we got retail fund flows. We have cash on the sidelines. We have just, generally speaking, what happens when an incumbent is on the presidential ballot. I think a lot of it is the Fed just doesn't want to upset the market. But that leads me into point number 3 is, the Fed has stated that they're finished hiking. I hope that stays the case. Nobody knows. I certainly don't know if I believe their inflation, indicators. I mean, who doesn't use food and energy, right? I mean, we probably spend 30 to 40% of our, monthly income on food and energy in some form or fashion. But the Fed has indicated that they are finished hiking. And you have to understand the impact of rate cuts on equity markets. And it is tricky. On one hand, the interval after a string of U.S. Federal Reserve rate increases ends and before the first rate cut begins, typically is a good time for stocks. Again, it doesn't have to be, but the gains in the market since the Fed's final hike in July of 2023 are about equal to what the average has done of the stocks have done historically in such a period. but it's a challenge. It's a challenge in that the market has priced in 6 rate hikes this year. Well, at least they did at the end of last year. Rate cuts. 6 rate cuts. Well, now they're pricing in 4. But there's this little thing called sticky inflation and this thing called the markets are doing well and, employment is strong. So the Fed it's a very tricky situation. Nobody knows that they're going to cut rates. The markets are certainly betting that they're going to cut rates. If they do cut rates, I think you will see the markets continue to run. I think you will see some fixed income strategies do well. But you look at what fixed income is, in a lot of instances, has been cut in half over the last 4 years. And the average advisor, that's what they're going to give their clients to protect their money. How has that worked for you? Seriously, how has that worked for you, especially in 2022? We are in a bear market in bonds, and maybe we're out of it, but it's so disappointing that the average investment advisor is creating strategies that didn't do what they were supposed to do when the markets were down, the bond market. It's easy to sell a bond. I mean, it's simple. Most people know what bonds are in some form or fashion. They think they're safe. Well, they're safe when rates are going down, no doubt about it. And when the rates go up like they did, look at how much money people lost in bonds, 20, 30, 40%. And again, we're on a mission to change that. So 630-492-1912, 630-492-1912, and let's have a conversation. So point 4, inflation numbers, they are cooling, no doubt about it. There was some hot numbers this week, but we generally speaking, we've seen good incremental news on inflation, which generally, will allow the Fed to continue to sound less hawkish, which, can certainly help the market. And I hope it does, because if not, we could see markets, generally stair step up and the elevator down. And if inflation comes back, and if inflation, all of a sudden rises again, which many smart people think could happen, I think it's anybody's guess what will happen in the market, because the concentration in the market is historic. And when you look at what is ultimately going on in the market, it's just a challenge. We've all heard of the Magnificent Seven, right? Just Google them. You can look at the stocks. Some are saying now it's the Magnificent Six, but the Magnificent Seven, Tesla hasn't done very well. So some say the Magnificent Six now. But since February 2023, those 7 stocks returned 77%. Think about that, 77% in just those 7 stocks. The S&P 500, 20%. So February 2023 to February 2024, Mag 7, 77%, S&P, 20%, the Russell 2000, 5%, the S&P 500 equal weight index, only 4%. What most people don't realize is the S&P 500 is a market cap weighted index, meaning the bigger the company, those returns are going to disproportionately affect the overall returns of the S&P 500. But if you look at the equal weighted S&P, which doesn't matter how big the company is, they equally weight those 500 stocks, it's only up 4%. So if you remove the Magnificent Seven from the S&P 500, the market is barely up. And that's, barely up 5% over the last year. So, which is really money market rates. So you look at the risk that you're taking to get that. And so, yes, I think when you look at the market and you look at the things that work, that give us, we think it could help the market, fund flows, cash, incumbent president is on the ballot, at least as of today. The Fed is, we think has finished hiking, and inflation numbers are cooling. What happens if one of those or two of those doesn't transpire? What does that do to the market when so much concentration is at the top? So we'll get into more of that after the break. 630-492-1912, 630-492-1912.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Our job is to craft portfolios that can do well whether the markets are up, down, or sideways. And yes, those strategies do exist. Strategies do exist that you can make money in a down market. It's called a predefined outcome strategy. Those strategies are offered by the largest banks and financial institutions in the world. If you do not have those inside of your portfolio, we need to talk. 630-492-1912. 630-492-1912. Give me a call. Give Paige a call. Set some time up. Let's get on a calendar. Let's have an initial 5 to 10 to 15 minute call and let us educate you on strategies that can do well, can make money when the markets are going down, or strategies that can greatly reduce your taxable income and pay distributions in the 12 to 18% range that is not dependent upon the stock and bond market. So those are the things that we want you to think about. Driving around today, Saturday morning, listening to the podcast, if you can't point to a bucket of your money inside of your portfolio that you know that if the markets are down 20%, your returns would be positive 20% for that investment, let's have a conversation. Now is the time to do it. Markets are doing well. Now is the time to make sure that you don't give back all of these gains. So 630-492-1912. Also, if you live near a Morton's Steakhouse, or you would want to drive to a Morton's Steakhouse, there's several throughout the Chicago area. If you have $1 million of investable assets or more, and you want to greatly reduce your taxable income by investing in the energy space, reduce your taxable income to the tune of 70 to 80%, so $70,000 to $80,000 per $100,000 invested, and have an investment that has targeted distributions in the 12 to 18% range that are not dependent on the stock and bond market. Let's have a conversation. Give Paige a call, 630-492-1912. Let us share with you what those dinners are going to be about. Let us give you the dates, and if you still have an interest, we can certainly set up an RSVP for you. The last dinner, we had 65. Well, no, that was just one night. We had about 80 people on the wait list. So unfortunately, we were not able to get to everybody who wanted to go to the dinner in Naperville. But again, we work with everybody, whether you have $100,000 or $10 million of investable assets. We want to work with people who want to know that they have strategies that can do well in good and bad markets. But for this dinner specifically, the requirements, not my requirements, but the requirements per the SEC, is you have to have $1 million of investable assets or more. So 630-492-1912, and we can have that conversation. So, okay, last topic on point on why we think the markets could have a very, very positive year. Market breadth has turned positive. And in late 2023, really in Q4 of 2023, 90% of the stocks in the S&P 1500 index moved above their 50-day moving average. Now, that's a technical indicator, but it's really a technical indicator of market breadth, i.e. the overall direction in which stocks are moving. That is, tends to be bullish for stocks. And what that shows is that investors have really flipped from selling to buying. And the problem with that is it's backwards looking, because it could flip just as quick going forward. And I saw some great statistics this year that, the title was Smart Money is selling at record levels, but basically it's insiders are selling out of the market, corporate insiders. It really is at an all-time high. And I don't necessarily know if you can use that as a good indicator of what is going to happen in the market, but insiders are getting out, and generally insiders have a very good understanding of what is going on inside of the market. But there's so many mixed signals in the market. Saw another statistic this week that fund managers now have the highest allocation to U.S. stocks since November of 2021. And they do. I mean, now 2021 was still higher, but they do have the highest allocation to U.S. stocks. So, the problem with all of this information is when individuals make decisions, they generally it's confirmation bias. It's whatever they think is ultimately going to happen, whether they're right or wrong. It's just kind of their gut feel. And then they're going to find statistics that make them feel right, or, strategies that confirm that will, or statistics rather that confirm that they're doing the right thing. And that's the beauty of investing the way that we do, because again, up, down, and sideways markets, that's it. We want to have 4 distinctly different strategies in a portfolio. Protection, strategies that we know can make money when the markets are down, or at least preserve principal when the markets are down, or at least know that here's what has to happen for us to lose money. So that's our protection bucket. Our growth bucket, we want to use computers. Computers. The big firms, the big funds, the big hedge funds, 5, 10, 50, 100 computer programmers on staff. It's not by chance. It's not guessing. And the problem with that is you generally don't have access to those strategies. There are a handful that the average investor can get into, and those are the things that we are bringing to the table. You can't get to them direct, at least the strategies that we are offering, but they're very mathematical based. And so again, it just doesn't matter what happens in the market. Our Growth Plus allocation is just that. We want Growth Plus. We really want to take advantage of the market. We really want to take advantage of market swings. And then lastly, are tax and alternative strategies that can greatly reduce taxable income, strategies that can pay, targeted double-digit distributions regardless of what is going on in the market. So when you look at statistics that insiders are selling at the highest level in history, that fund managers are the highest allocation to equities since 21, those are 2 conflicting data points. So if we have a portfolio that it really doesn't matter who is right, because ultimately you're going to win with something in your portfolio, well, then ultimately, we as advisors are doing our job. It's kind of that heads I win, tails you lose philosophy. Heads I win, tails you lose. I win both ways. And again, nothing is perfect, but if we have money, if you have a portfolio constructed that you're going to win no matter what for some of your money, well, that's, we take away that market worry. We take away that, we don't have to guess the market. We don't have to look at the crystal ball. We don't have to think that, well, the markets can't continue to go up, can it? Absolutely. Look at NVIDIA. Look at that stock. Well, it can't go up. Well, people were saying that at 500, 600, 700. And so it does, and it did. And the markets just don't care what you and I think. And that's the job of an advisor. The job of an advisor is to create a portfolio that you can win no matter what. In worst case scenario, maybe it lessens, big drawdowns. But, the job of an advisor is to bring you that. But unfortunately, the job of an advisor is to bring you a closet index fund strategy, a strategy that you could create a very simplistic strategy. You could create it within 5 minutes on the computer, and the advisor is going to charge you 1% to 2% for that. And that's just not good enough. So hopefully you got something out of the show. If anything I talked about piqued an interest in any way, generally speaking, we like to have an initial call. We work with advisors, or clients, no matter how much money they have. The dinners, so if you're near Morton's and you want to learn about tax reduction strategies and distributions that are paid, independent of the market, you do need a minimum investment of $1 million of investable assets for those dinners. Again, get on the list, because the wait list will fill up very, very quickly. But if you don't have $1 million of investable assets and you want to talk about your individual situation, we can certainly do that as well. We have those strategies. The beautiful thing is many of these strategies today, the minimums have come down. Like those, the bank notes that we often talk about, the minimum investment is $1,000. I mean, think about that, $1,000. We did an income note this week that you received 11% and you had 50%, 11.2% annually. Actually, it was a 2-year note, 23 months, JP Morgan note, and you received 11.2% annually, and you had 50% downside protection before you had to worry about losing money. A lot of people will take those strategies. If you can tell me you have a 50% downside bucket to make 11.2, well, that may make some sense for your protection bucket. So again, our competitive advantage, I don't care what way the markets go. We're going to craft strategies inside of your portfolio that at least something can do well. And if something does well, well, it'll mitigate what doesn't do well. And then hopefully we can hover around that flat line. So give Paige a call, 630-492-1912, 630-492-1912. Hope everybody has a great week. We'll be back with you next week to hopefully give you more ideas. That's our job. Take care.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.